Let me ask you a question. You ever bought a Powerball ticket and dreamed of what you'd do if you hit the jackpot? New house, no more bills, or a retirement? It's fun to dream, right? Well, here's the reality. The odds of winning a Powerball jackpot are 1 in 292 million. That's right. To put that in perspective, you're more likely to get hit by lightning not once, but twice in your lifetime than win the Powerball jackpot. So why do people still play? Well, it's the what if factor. But hope's not a strategy. And today, I want to show you a way you can take the same Powerball dream and actually flip the odds in your favor, not with a lottery ticket, but with the real consistent income strategies in the stock market with something I call the 90-90 strategy. Let's talk about it. Hey everyone, Tom Gentile here, America's Pattern Trader. Welcome back to the channel. Today I'm going to discuss the realities of the Powerball lottery and something I call my 90-90 strategy. So, revisiting Powerball, think about this. The next jackpot's going to be 1.7 to possibly 2 billion in the next draw. But what are the odds of winning? I already told you 1 in 292 million, but let's take it a little farther. Second prize, $1 million, 1 in almost 12 million. Even a small $50 prize, 1 in about 39,000. So the numbers are stacked against you from the start. Here's the kicker. Most people don't even pick the numbers in a way that makes sense. Some use quick picks. That's the randomly generated number by the computer. Probably the best way to pick. Others use birthdays, anniversaries, lucky numbers. But guess what? Birthdays only go up to 31. So those numbers are overcrowded, and that means your odds drop because of two reasons. Number one, you're missing out on all the numbers above 31 that could be in the draw. And number two, if you did win, there's a high chance you're going to be splitting that pot with others. So at the end of the day, no matter how you pick the lottery, it's designed to make you lose. Why do people keep playing? It's fun. The dream of a life-changing win is exciting. For a few bucks, you get to imagine what life would be like if you never had to worry about money again. But here's the problem. That dream almost never comes true. For 99.9999% of players, most of those tickets end up in the trash. And for the small few that do win, well, about a third of them are broke about a year later. So instead of hoping for a miracle, what if you could build your own Powerball strategy where you could consistently make money week after week, month after month, without impossible odds? Let's talk about the stock market. Now, most people pick stocks a lot like the lottery. They rely on family, friends, inside tips, and they buy on hope. Now, more recently, entered these new ultra high yield income ETFs. They become all the rage, like ULTY. I don't like them. My short answer is I think these funds are nothing more than publicly traded Ponzi schemes. I know, I said that. They lose more money than they make over time. For the long answer, take a look below. I'm going to drop a link in on a video that I did recently on ULTY. Now, let's crank these probabilities up significantly. I want to introduce you to my 90-90 strategy. It involves both stock and options. Let's talk about the stock part first, which is the first 90. That 90, I call it historical probability. It's the win rate I'm looking for a stock to move up or down in the same period over the last 10 years. It's a repeatable pattern. I like repeatable patterns that happen over and over again. It's what I call seasonality. And it starts with a calendar of mine. Now, this calendar only shows stocks that have had a 90% or better historical pattern of success over roughly a 30-day period going back 10 years. Take a look at September. It's a weird month. It starts out bearish. A lot of stocks are poised to go down. But in a few weeks, this is all going to change. And we're going to start seeing the calendar make a seasonal bull run that runs in the end of September through to the end of the year. Now, I want stocks that are on that part of the calendar, and here's one of them, Steel Dynamics. Now, on September 22nd, the calendar turns green, and Steel Dynamics is one of those stocks. This one's slated to go on a 38-day price run. During that time, I'm expecting about 11.5% return on the stock. Now, how do I know this? Because I have decades of data like Steel Dynamics, which shows me that during this time frame, it's made the exact same move around the exact same time in 9 of the last 10 years. Take a look. You can see 9 of the last 10 years. The only loser was in 2018. The last 6 years in a row, this pattern has gone up. It's gone up 9 of the last 10 years. That's 90% historical probability. That's the first 90 of my 90-90 strategy. Now, before I get to the next half, if you're looking to become a pattern trader, check out all my research on patternsandprofits.com. Best of all, it's free. Link is below. All right. The second 90 in my 90-90 strategy is statistical probability. That's the probability a stock's going to remain above a certain level by a specified date in the future. Right? We've already talked about historical probability. That's the past. Statistical is a theoretical move in the future. Now, if I bought Steel Dynamics today at today's price, $130, whatever reason, fundamental, technical, seasonal, statistically, I still have a 50-50 chance that stock's going to be above or below my strike price or my buy price going forward in time. Either it's tomorrow, next week, next month. Now, those numbers skew to the upside for long-term investors, but for short-term traders, think of it as a 50-50 chance. How do we bend the odds in our favor? By lowering the price of the stock and getting paid for it in the process. Here's how it works using Steel Dynamics. Let's say stock's at $130 a share. You like the stock, but you want to buy it cheaper. So you sell a put option at $100. That means you're agreeing to buy the stock at $100 if it drops there. In return, someone's paying you up front for making that promise. Let's say you get paid $3 a share. So that's $300 for a contract. Now, two things can happen. Number one, if the stock stays above 100, you keep the $300. The option expires worthless. You keep it all. If the stock price drops to $100 or lower, you buy it at the discount you wanted, and guess what? You still keep the $300. So either way, it's a win-win. Here's the big difference. With Powerball, your odds are 1 in 292 million. Using seasonality like I do, my historical patterns are 90%. Add on put selling with statistical probabilities, depending on the stock and strike price you choose, your odds of keeping that premium are also positive, sometimes 90% or more, which represents the second 90 on my strategy. Now, those are some odds that are actually in your favor. So instead of wasting money on lottery tickets, you can buy puts on some strong popular stocks, Apple, Microsoft, even ETFs, during seasonally bullish times of the year, selling puts on companies you'd be happy to own anyway. Each time you sell, you collect income in your account, cash up front. Do it week after week, month after month. You're building what I like to call a consistent Powerball income strategy. Now, here's the key. This is not gambling. This is a repeatable process. You're stacking the probabilities in your favor, and you're getting paid to do it. It's like creating your own lottery system, except in this game, you're the house, and you know the house always wins. Thanks for watching. Like, subscribe, and share if you found this useful. And don't forget to leave your comments as well. See you on the next one.